Well, thank you. Right? If anybody wondered whether NAAHL was on the cutting edge, the Secretary of HUD called for data and evidence. And what is your first panel? Data and evidence. So we're all very happy to be here to share with you some of recent research and efforts being done by economist profession and others, but I think we're all economists here, but other researchers. We have an extremely distinguished panel. You have their bios, so I'm not going to take time to read those. We're also very lucky that these gentlemen could join us because we're actually competing with a number of other organizations in the country. Two of my colleagues, Ingrid Ellen and Kathy O'Regan, who actually spoke, I think, a couple of conferences ago, are giving papers there to also enlighten the world. So, but we have here some terrific research and some terrific people who have done work in the areas that overlap and can help inform, I think, the work all of you are doing on the front lines of the financial industry to working on rebuilding communities and strengthening communities. That this research can be very helpful. I was going to start off by talking a little bit about, this is a little bit of a wonky panel, but I think what you're going to really learn here is it's not. Much of the work we're going to hear about is really about what the data tells us. And we'll talk a little bit later about why some people seem to see different things than we're going to hear here, but what careful analysis and thought, looking at the data and the history, what can we really learn that tells us about the strength of the work that you all do and the importance of that work. So without further ado, we're going to have 3 presentations. Then I'm going to try and engage this group in a little bit of a conversation up here. And then we intend to open it up for your questions, which can range from the specifics of what you've heard here to whatever else might interest you in the world of research. So I think you're going to start, Paul?
I am?
Yeah.
Oh, okay. Do we have a...
Yeah, we do. I guess I have it then. I didn't realize I've been the one given that honor.
Oh.
They're out of order? This is the order they're in?
Who? Neil first.
Well, actually, okay.
I mean,
yeah, right.
I mean, if you want
That's fine, Neil. I don't know how that happened.
Okay. Is this, everyone can hear me? Okay. So my name is Neil Bhutta.
Actually, yeah, right. I need to say Neil is one of the foremost experts at the Fed on HMDA. He's been doing this for a number of years with some great colleagues, and I'm sure he's going to tell you that. But this is a really good example of what a hard look at the data can really show us. So thanks, Neil.
Yeah, so I'm going to talk a little bit just briefly about some recent trends we see in the data in CRA and LMI lending. So I'm an economist at the Fed in the research division, and I've been working on this kind of stuff for the last 8 or 9 years. Just a couple of quick preliminaries. I'm here just presenting, my own research and work I've done. These are, you should think of these as, any views are my views and not necessarily those of my colleagues or the board or the Federal Reserve System. I want to give a quick shout out to some of my colleagues that I work with on this stuff, Dan Ringo and Steve Laufer and Jimmy Kelleher. If there's anything, the things I'm going to show you, you can find online on, on the Fed's website if you look up one of our names, if you just Google one of our names. And then finally, this is about CRA, and I'm going to be focusing on mortgage lending, which of course is just one component of CRA. I recognize that. So, but it is, of course, an important component of CRA, but that's going to be my focus here. So one of the, CRA has been around for a very long time, and we've been sort of enforcing it in a very similar way for a very long time, and that centers around this concept of assessment area. And I think, in a changing financial landscape, as we see, people's financial lives moving online, there's been a lot of concern about does the concept of assessment area, is that still meaningful? So one of the things I wanted to show is just in the data, at least with regard to mortgage lending, what we still continue to see is a strong tie to assessment areas in terms of where banks are making mortgages. So in 2016, which is the most recent data that we just put out, we still see close to 70% of mortgages that are being originated by banks being within their assessment area where they have branches. And that's very similar to what you would see if you went back 15 or 20 years ago. So in 2000, we see a very similar number. 2005, during the housing boom, that dipped a little, but we've actually, that number has come back. So at least in terms of what you see here, the idea of assessment area doesn't seem to have completely lost its meaning. One thing you might be a little bit more worried about in terms of CRA is the fact that non-banks, which are not covered by CRA, actually have really been increasing their share of mortgage originations. So what you see by 2016 is, if we look at credit unions and particularly independent mortgage companies, their share of mortgages has gone up to 60%, which is way above sort of the average 40% levels that we've seen historically. So essentially, mortgage origination activity is shifting away from banks to institutions that are not going to be covered and examined under CRA. So is that necessarily a bad thing for LMI households? Well, not necessarily. At least just in terms of LMI mortgage lending, what we see is this group of non-bank institutions. Actually, if you look at any year from 2010 through 2016, these non-bank institutions are more likely to be doing LMI lending. So the share, the blue line, the share of their mortgages, home purchase mortgages to LMI borrowers exceeds that of the largest 3 banks, which is the black line, and all other banks combined, which is the light green line. So a couple other things I wanted to point out. We're also seeing a pretty sharp downward trend overall across all of these institutions in LMI mortgage lending, from well above 30% to below 30%. The second thing that is really striking about this is the really particularly sharp and disproportionate drop in LMI lending amongst the largest 3 banks. So that number has gone from close to 33% all the way down to about 15%. So that trend we noticed this year, or in the last few years, was really striking to us. And so we were trying to understand what might be driving that. And one of the other things we also see in the data, and this goes back a little bit to what we just heard from Secretary Carson. In the last few years, if we look at any of these institutions, so from 2010 to 2014, there has been a drop in FHA lending across all these institutions. And that's the sort of common drop across all the institutions we think is very closely related to increased insurance premiums over this time, reducing demand for FHA. But what we've also seen is a really disproportionate drop amongst those largest 3 banks. And the largest 3 here are Wells, B of A, and JPMC. There's been a huge decline in FHA lending amongst those 3. So from above 40% in 2010 and 11, so 40% of all their home purchase originations were FHA back then, all the way down to about 5% in 2016. And so even though FHA premiums were reduced in early 2015, and that seems to have stabilized FHA lending for non-banks and other banks, for the largest 3, it's been continuing to go down. And so we think this might, we're not exactly sure why the largest 3 have really reduced their FHA lending so extremely. But these banks have been particularly vocal about some of the issues related to litigation risk under the False Claims Act, and so they seem to have been particularly sensitive to those risks and really gotten out of FHA. So as they've gotten out of FHA, that has a direct implication for their ability, perhaps, to do LMI lending. And so we think these two trends are very closely connected. I think an important question, though, that we have to ask is, if the biggest banks are getting out of LMI lending, is that necessarily something to worry about? From a CRA enforcement perspective, yes. And just to be clear, I have nothing to do with CRA enforcement. But obviously, LMI lending is a big component of CRA evaluations. So potentially, this has implications. From a household's perspective, or from sort of societal welfare perspective, maybe not. I think a key question is whether other lenders are filling in those gaps, whether other lenders are able to fill in when large banks are unwilling to make those loans. And there is some new research in this area that seems to suggest, it's a little bit mixed, but there is some research that suggests that when the largest banks sort of exit a market, other institutions, other lenders do fill in those gaps pretty effectively. So moving away from exactly which institutions are doing LMI lending, overall we did see a big decline in the last few years in LMI mortgage lending. And so an important question is just overall, does this have to do on the credit supply side, or is this something that's going on the credit demand side? And we think that there's at least some reason to think that credit demand might be an issue. And in particular, one of the things we've seen in the last few years is really sharply rising house prices in some parts of the country. So this graph shows, on the x-axis, you can see growth in household income, and on the y-axis is median home value growth from 2012 to 2015. Each of these dots is a county in the US. And so most counties, you can see, over the last 3 years or so, cumulatively have experienced about, somewhere in the neighborhood of 10% income growth on average. So they're all clustered between 0 and 20. When we look at house price growth on the y-axis, you can see a lot more spread. And what you can see is, there's a lot of counties where house prices are growing way above 10, 20%. And so house price growth is outstripping income growth, and that can lead to affordability problems, particularly for LMI borrowers. So what we've tried to start doing is ask whether whether rising house price growth is really impeding home buying for lower income borrowers. And so what you can see here is, on the x-axis, growth in home values. On the y-axis, the changes in the likelihood of a household buying a home. In the light blue line, it suggests that for higher income households with incomes above $50,000, as you go up as you go into areas that have been experiencing faster house price growth, that really hasn't yet caught up with them. So their likelihood of buying a home is pretty constant over these places. For lower income households, you can see that in places where house prices have been pretty stable, they look pretty similar to the higher income households. As you get into places where house prices are growing really strongly, we're starting to see that their likelihood of buying a home is deviating away from those higher income households. So this is suggestive, some initial evidence we've been able to put together suggesting that rising house prices, outstripping income growth, is starting to catch up with lower income households. So that's what I wanted to talk about today, so I'll turn it
Thank you,
over
Neil.
to-
I want to make sure we go to not the next presentation, skip a presentation, because otherwise we're going to get way out of order here. So if you could get to Paul Willen's presentation. Well, I say a few words here about Paul. I don't know how you're organized back there. So do you have to go through a presentation, or are they separate? There we go. All right. You're on, Paul. So we have another Fed economist. Paul's been doing a lot of work here on subprime lending and the impact of foreclosures, et cetera, and is going to share some recent work that he's been doing. So thank you, Paul.
Thank you, Mark. So let me start by saying I'm speaking today as a researcher and as a concerned citizen, and not as a representative of the Boston Fed or the Federal Reserve System. And so when I say we, I don't mean Janet. I'm going to have to replace this picture soon, and me. Okay, so the starting point for much of my research, and in particular what I'm going to discuss today, is what we know about what happened. So where Anil was talking about the present, I'm kind of stuck in the past. And so we're still debating what happened in the crisis. And you all know the big run-up in mortgage debt and the subsequent crisis and the subsequent foreclosure crisis. That was the big story, at least in housing. And we saw this big explosion in debt in the early 2000s, which was not accompanied by a corresponding increase in income. So one explanation you could sort of reject right off the bat is that the reason debt was going up was because income was going up. And so why did that happen? And the narrative has always been about this boom and bust, has been about a credit expansion. And that's why Mark wanted me to talk today, this credit expansion, and we can debate about why there was a credit expansion, and that's what there was a lot of debate about, but that's not what I'm going to talk about today. But the point is here is what happened in this credit expansion? Well, we had this boom in subprime lending. I don't need to go into much detail with you about that. We had big increase in low down payment mortgages. We had the increase in reduced documentation, in the incidence of reduced documentation. And the theory was that what had happened in the boom, that big increase in debt, was driven by a shift of lenders of credit to previously underserved populations. And the result of that was that when we had foreclosures, those foreclosures were disproportionately in the places to where all this credit, in some sense, had been misallocated. And the key to this story, as I said, was that there was this big shift in the way lenders lent, and that allowed all kinds of people who previously couldn't get mortgages to get mortgages, and it also allowed all kinds of people who previously were limited in how much debt they could get to get more. And so what I'm going to tell you today is that's not what you see in the data. So in the data, what you see is that, in fact, most of the new debt in the boom actually went to the highest income households. And you can look at this picture, and once you see what's in this picture, what you see is that we're ranking people here by income. So the first group over there, they're ranked by income of households by zip code. And so 1 is the lowest income zip code, and 5 is the highest income zip code. And what you see basically is there are many different ways of saying the same thing. Debt grew proportionally by the same amount everywhere. That means the share of debt by income stayed more or less the same. The highest income households accounted for about something like 30% of the debt in the 40% of the debt in the before the boom, and they accounted for about 40% of the debt after the boom. In dollars, since they accounted for so much of the debt to begin with, it means most of the dollars went to the highest income zip codes. And what we're doing here is looking by zip code, and so these are high income zip codes. In other words, there was something like $1.5 trillion worth of new debt went to people with to zip codes in which the median income was $87,000 according to the IRS, and the median credit score was 750. So these were not people who were previously denied credit. These are the people who previously had no trouble getting credit. And so the first thing to say is they took on proportionally just as much debt as the people down here at the bottom. And so when you go look in the data, you don't see this story about that there was this massive reallocation of debt to previously underserved areas. The second thing story was that we had this big influx of people who weren't really qualified to own homes, a big increase in of people who shouldn't own homes. And so what we're looking at here is the so-called extensive margin, which is the probability. So the way we're measuring the transition into first-time home ownership is looking in the credit bureau data and looking at when people first transition into home ownership. And let me say that this actually was first documented by NAAHL here, and this is basically just replicating what NAAHL did. And basically what you can see here is what we've done is this is the hazard. It's the probability of someone transitioning into home ownership. And we're dividing people up by the credit score they had before they bought a house. And what you can see is the probability of transitioning into home ownership is almost always highest to the people with highest credit scores. That was true throughout the boom. And what's significant, though, is that in the peak of the boom, the probability of transitioning into home ownership is actually going down, not up. And it was low, very low for the people with low credit scores, and it stayed low throughout the boom. So this idea that there was this explosion in home ownership among low credit score people, you don't see that in the data. What you see is across the board at the peak of the boom, you see how home ownership, the transition is going down. And what that, as anyone who remembers the time remembers what was going on there, it's true that it was easier to get a loan in 2005, but it was much more difficult to buy a house because house prices had gone up so much. And clearly the house price effect is offsetting the easy credit effect. And another thing to point out here is that one of the big growth in subprime lending, if we look at purchase mortgages, what you can see here, so the blue line is subprime, and you can see the big rise in subprime. The red, very hard to tell these lines apart. This is not my, I shouldn't say this. My colleague did this picture, and he and I have a long, he thinks my figures are terrible, and I think his figures are terrible. And so he grudgingly uses mine, and I grudgingly use his. And if he were up here, he would say, Paul made this figure. So I'm only just what goes around comes around. The point is here is the line that's going down in the early 2000s, that's FHA. And basically, what is FHA doing? What is subprime doing? A lot of what it was doing in the purchase market was basically just cannibalizing FHA. So it wasn't really increasing the availability. I mean, in the end, the incidence of credit was just shifting from FHA to subprime. Okay, so the last thing, the last key fact here that sort of ties this all together is about defaults. So what does this picture show? This is the share of mortgages, the share of defaults in the country by zip code, and then we're ranking them by the lowest quintile means the lowest percentage of low credit score borrowers, and the gray one is the highest percentage. So in creditworthiness, the high means less creditworthy, and low means more.
You didn't do this one either, I'm sure.
Anyway, it's not the way I would have done it. Anyway, so the point here is that, I don't know if I can go back to Boston. Anyway, the point is here is that you actually see the gray area, that's the least creditworthy. They always account for a big, so in the crisis, there was no question that a disproportionate number of the foreclosures were in areas with less creditworthy borrowers. But the reason for that was because there are always more defaults in places with less creditworthy borrowers. And you can see, in fact, the share of defaults among the most creditworthy borrowers, it actually went up slightly. Now, the point is, the pie is growing dramatically. It's tripling here. So defaults are going up everywhere. But the point is, they're not going up disproportionately in areas with a lot of low credit score borrowers. All right, so let me just finish with one last thing, which is some new research that we're doing, actually looking at the credit expansion of the 1990s. I think it is possible to argue that what happened in the 1990s more closely approximates what people think happened in the 2000s. And without going into too much detail, what this figure shows is a way of measuring the relationship between income and the amount of mortgage credit you could get. And the idea here is that the higher the sensitivity of mortgage credit to income means it's more difficult to get a loan. In other words, your lending decision is more sensitive to how much income people have. And what you can see is that sensitivity came way down. In other words, it got much easier to get credit. But that all took place in the 1990s. And that's the advent of automated underwriting. There's all kinds of things we know about. We can document in the sort of narrative evidence that there was an expansion of credit in the 90s, and you can see that here. But it basically stops sometime in the late 1990s, and nothing happens in the 2000s. And so you say, did this credit expansion lead to a boom in house prices? And the answer is no, actually. So what you can see here is the big increase in house prices. This is house prices relative to income. The big increase in house prices really doesn't start until the early 2000s, throughout this period. So what did this credit expansion do? So this credit expansion led to a big increase in homeownership. So over this period where it became easier for people to borrow, or the lending became less sensitive to income, we see a big increase in homeownership. And so where did those homes come from? Why didn't that drive up the price of housing? And the answer is because what happened was that there was a big shift in properties, basically from rental properties. Where did you get the properties to sell to these people? You transferred the rental properties. And so the blue and red lines there, so the red dashed line, that is properties that transition from renting to owning, from owning to renting. And then the blue line is the properties that transition from renting into owning. In other words, they're a rental property, and this is in the AHS, and then the next survey, the same property is owner-occupied. And what you can see is, under normal circumstances, the transitions from own to rent actually outweigh the transitions from renting into owning. And the reason for that is because of new construction is almost all, the single-family new construction is almost all owner-occupied. And so the home ownership rate can go up despite the fact that on net, properties are transitioning from ownership into rental. But you can see here, in the late 90s, you see a sort of odd period in which what was happening was a lot more properties were transitioning from rent into own than were transferring back from own into rent. And then you can see, starting in the mid-2000s, it goes into reverse, and we get the decline in home ownership that's been documented in many places. Okay, and so let me stop there. Okay.
All right. Paul, thank you very much. I think I can. I think I can safely say the first two presenters here have stayed away from what you think of economists doing, regressions and complicated models, and just looking at, if you really look at the data and think about all the different pieces that you need to understand to see what happened in the subprime crisis and what's happened since, the data tells you that. And we'll talk a little bit, if we have, about why, despite the fact that data tells us that some people have a different point of view. This other part, and Paul and Neil do this as well, but this third presentation is to show, in a world that's very complicated, so we often talk about partial equilibrium and general equilibrium. Lots of factors affect markets, and there are some very innovative ways now of trying to understand all of the factors that go in and to separate them out and to really be able to talk about what is the impact of something, what is the, if we can find some causation, causal relationship, et cetera. Tim and his co-author, Rebecca Diamond, have done some amazing work here and continue to do that. And he's going to share a little bit of that here. So, Tim?
Great. Thank you very much. It's a pleasure to be here. As was mentioned, this is joint work with Rebecca Diamond, and I'm going to be shifting gears here a little bit and talk about affordable housing. So I'm sure it's no surprise to anyone in this room, but affordable housing has become an increasing part of the policy debate due to rising income segregation and rising housing costs in many of the United States' most productive cities. Coinciding with this policy debate, there's been a real policy question of where we should locate affordable housing. And there's different strategies here. So if you look at the federal government, they tend to incentivize affordable housing construction in low-income areas through the use of qualified census tracts as part of the LIHTC program. But if you look at places like New York City or San Francisco, really the goal there has been to create what's known as mixed income housing, okay, which is to locate affordable housing in higher income areas with the idea that that will help the low-income residents, but that essentially moves them to opportunity, and I'm going to talk more about that. And the Obama administration had a bit of a push on that front as well, to basically create mixed income neighborhoods. Now, whenever we talk about where we want to locate affordable housing, though, what always comes up as part of the policy debate is, well, what is the impact on the local neighborhood when we build affordable housing in that particular neighborhood? Now, this is a difficult question to answer because it's not random where affordable housing developments are located. Okay? A developer is going to kind of choose a particular location based on what that developer thinks is happening to the neighborhood. So what we're going to try and do in this paper is try and get at some causal evidence of, well, what does low-income housing actually do to the local neighborhood? What is the impact of affordable housing construction on local residents? Okay? And the lens by which we're going to study this question is we're going to look at the universe of projects that have been funded through the low-income housing tax credit, which I don't need to describe in detail to this audience. Okay? And what we're going to do is we're going to look at a variety of different outcomes at the local neighborhood level and try and get at, well, what does affordable housing construction do to, for instance, local house prices? What does it do to crime? And what does it do to neighborhood demographics? And then using some economic modeling, we're going to use these estimates, in particular our estimates on local house prices, which will capitalize kind of the amenity value of the neighborhood, and we're going to try and quantify the costs and benefits of affordable housing to surrounding neighborhood residents. And in particular, what we're going to really be interested in is heterogeneity. In other words, we want to compare the impacts of affordable housing across different types of neighborhoods. What happens if you build affordable housing in low-income neighborhoods, and what happens if you build low-income housing in richer neighborhoods? So let me just give you a preview of the results, and then I'll talk a bit about the data and show you some figures which kind of show these results in more detail. What we're going to find is that there is indeed quite a bit of heterogeneity in the impact of affordable housing construction on neighborhoods. So, in particular, and what I think goes against the narrative to some extent, or at least the narrative that some people put forward, is that in fact, low-income housing can actually be quite a boon for particular types of neighborhoods. And what we find quite strongly is that if you build affordable housing in low-income neighborhoods, that leads to 6.5% appreciation in local home prices. So this seems to be, and to us this makes sense because basically what you're doing, a lot of these neighborhoods have very depreciated housing stock. Okay? They have a lot of vacancy. And what's going on is you're coming in and you're actually putting in nice new housing in that area, and that leads to positive spillover effects on the rest of the neighborhood. Now, conversely, we do find some price depreciation in the highest income areas, but only in low minority, high income areas. Okay? We don't find any depreciation in high minority, high income areas. We then quantify the welfare impacts of the affordable housing construction, and we find that because low-income areas tend to be particularly dense, the welfare benefits of a single affordable housing construction in those areas can be quite large. With average household benefits of approximately $8,800 and total spillover benefits to the rest of the neighborhood of $116 million. Okay? Now, again, conversely, if you build LIHTC in higher income, low minority areas due to the resulting price depreciation, the average household in that area is going to lose approximately $3,000, but because these areas tend to not be as dense, the aggregate loss is about $12 million. Okay? So how do we do this analysis? What we're going to do is we're going to combine 3 data sets. So the first data set is from DataQuick, which provides the universe of housing transactions in the United States from 1988 through 2012. So this is going to let me see the every housing transaction basically in the country, and I know exactly where it is. Okay? I know its price, I know the square footage of the house, and I know how many bedrooms and how many bathrooms. I'm also going to then combine this with with data from the Home Mortgage Disclosure Act that Neil was talking about, and I'm going to merge this with DataQuick. And what this is going to allow me to look at is the demographics of home buyers. So now I know the race of the home buyer, I know the income of the home buyer. This is going to let me try to ask, if I build affordable housing construction in a particular area, what does that do to the demographics of the incoming residents? Okay, and finally, since this is going to be looking at LIHTC, my final data set will be the HUD Public Use LIHTC database, which provides information on approximately 39,000 LIHTC projects put in service between 1987 and 2012. Provides the project address, the year the funds are allocated, and the number of units. Okay? So now, obviously, I need to be a bit restrictive in the counties that I'm going to look at in my sample because I need a sufficient amount of volume of housing transactions to actually be able to get a good estimate of what the local impact is. If you are just in very low density areas, I'm not going to really be able to estimate that causal impact. So what you're going to see is that a lot of our estimation is going to be coming from the Northwest, from California, from Florida, and parts of the Northeast. And then we also have Chicago in there and other large cities. Okay, but I should to be upfront, it's not going to be every LIHTC project put in service. It's only going to be in those counties where I have sufficient amount of transaction volume to be able to estimate the impacts. All right, so actually now what we're going to do is we basically kind of develop some new statistical methods to get at this, but basically what we're going to do, since I have this highly local data, is I'm going to compare what happens to houses right next to the LIHTC project to those a bit further away, and that's going to kind of try and control for various trends that might be confounding the analysis. Okay? So here's the average impact of LIHTC on house prices, and what you're going to see on this axis, this is simply the year since funding. So this 0 is when the project gets funded. So this is post-funding and this is pre-funding. And this is distance to the LIHTC site, where this is 0 miles and this is up to 1.2 miles. So what you see from this figure is basically nothing. Okay? It looks like, on average, LIHTC really doesn't have much of an impact at all on local house prices. Okay? It's basically flat. What's quite interesting, though, is this average impact masks a lot of interesting heterogeneity. So now what I'm going to start doing is I'm going to look at the impact of LIHTC construction by neighborhood income. So here's what it looks like when I look at the impact of LIHTC on house prices for those census block groups. In other words, the LIHTC project is located in a census block group with a median income of less than $26,000. So what you can see here is that at the time of funding, there's a very sharp increase in local house prices, okay, which then continues rising over a period of 10 years. And if you kind of get this, and this is about a total over 10 years, a price impact of approximately 5 to 6%. It's highest, as you would expect, right next to the LIHTC neighborhood, and then it starts to decline as you move out from the neighborhood. So I think this is suggestive. This is our first sort of evidence that LIHTC projects, at least in low-income areas, serve as a revitalizing force for that neighborhood in terms of increasing the local house prices of that neighborhood. And remember, this is kind of controlling for local trends. If you then go up to the next income quartile, once again, you basically don't find anything. Okay? So when we are looking at neighborhoods of between $26,000 and $38,000, we really don't find much. Okay? So in the lowest income neighborhoods, we see this revitalizing impact. Now let's start looking at the highest income neighborhoods. All right, now you start to see declines. So in the higher income neighborhoods, once again, it's relatively flat up until the Light Tech project is funded, and once the project gets announced, you start to see some depreciation in the local area, and it's a bit sharper in the highest income areas. Okay? And we see here, over a period of 10 years, price depreciation of approximately, price depreciation of approximately 3%. Okay? However, these price declines in these highest income areas are only for low minority neighborhoods. So once you go to high minority neighborhoods, what happens is that you don't see that price depreciation. You don't see a lot of revitalization for us. It's reasonably flat, okay? But you don't see the declines that you would see in the low-income areas. All right, so what I think is quite interesting here, though, is that there is definitely an argument for affordable housing development being a revitalizing force in distressed low-income neighborhoods. Okay? So one thing that we can do to try and examine that a bit more directly is let's look at some other things that happen to the neighborhood when affordable housing construction gets built. So what we find is that in lower income light tech development attracts 5% higher income home buyers. In other words, okay, that when you build light tech in a low income neighborhood, going forward it starts to attract higher income homeowners into that neighborhood. Okay, once again, consistent with this revitalization force. We also find that development in high minority low-income areas decreases the black share of home buyers by 3 percentage points. In other words, somewhat counterintuitively, if you build in high minority areas, that can actually serve as a partial force to decrease segregation, because going forward, the equilibrium effect is that it starts to bring in less minority home buyers. Finally, we find that if we actually have local crime data, and we see that when you build affordable housing in low-income areas, you also see declines in property and violent crime, and we think this is also consistent. We looked at the data, and many of these light tech developments have security guards put in place. Many of them are replacing vacant buildings, all of which are generally associated with increased crime. Decreased crime. Yes, thank you. All right, let me conclude then. I'll just try and wrap this up. So then what do we do with all these price impacts? We use some economic modeling to try and quantify the benefits of local neighborhood change, and we decompose these impacts into the welfare impacts on homeowners, renters, and absentee landlords. And what we find is that in low-income areas, homeowners benefit quite a lot from affordable housing construction, on the order of $23,000. Renters benefit less. Why do renters benefit less? Well, they're getting the increased amenity value from the neighborhood, but they also have to pay higher rents. Okay? And the landlords then are collecting those higher rents. In higher income areas, it's the homeowners that suffer the most, and the landlords, the homeowners are suffering because their house prices are falling. The renters are getting lower rents, so it's kind of just a wash for them, and then the landlords get lower rents. So when you aggregate all this up, as I said, you get a total aggregate benefit to society when you have low-income affordable housing construction of approximately $116 million. And when you build light tech construction in high-income areas, you see a welfare loss to the neighborhood residents of approximately $12 million. So just to conclude, I don't want you, the takeaway to be here to say that, well, you should never build in high-income areas. Okay? We know from, this is only one of the welfare impacts of affordable housing construction. And we do know from evidence by, for instance, Raj Chetty, that there are considerable benefits of moving to opportunity, of moving low-income residents to higher-income neighborhoods. All we're saying here is that when you have a limited budget, okay, there is an opportunity cost to that when in the context of neighborhood revitalization and having community development in depreciated areas. And I think that a balanced approach, and one that takes into account the possible revitalization impacts of light tech construction, is important for policymakers to think about going forward.
Great, Tim. Thank you very much. Well, Well, we have limited time left, and Buzz has told me I need to stay on schedule. He's signaling whatever. So I'm going to turn to the audience in a few minutes if you have questions. But I want to just pose, we could go into the details of each of these. They're fascinating. So I want to pose sort of a bigger question. Maybe it's a little bit in the context of this world of do facts matter and who cares and whatever. I hope the Secretary does pay attention to the data and evidence, and that other people do as well who do housing policy. So I get it. You know, the subprime crisis wasn't caused by low and moderate income. They're not the source of all evil. And I think, Paul, what you showed here really indicative of that. And the famous statistic I often use, and I think you and you referred to it, one of you did, you or Neil, 6% of, only 6% of the mortgages that were subprime were counted towards any CRA, a measurement of CRA activity. So what was going on there is a lot more than something that CRA could be driving if it was only 6%. So Neil, you've certainly made it clear here that LMI lending is changing here. Banks' role is changing, but maybe not. That may not be a big driver of what else is going on. It's home prices and other pieces. And Tim, the amazing, I hope everybody can appreciate putting together all those data sets, doing all those pieces here, added to some other evidence that people had started to put together about increase in home prices around LIHTC and what the change communities can be. So all of this, I think, is very consistent with what people here in the room believe and what they see, and what arming them with evidence that helps them internally within their organizations be advocates against some of the myths that are out there. So I'm not quite sure how to ask the question, but I'll ask it this way. So what most frustrates each of you about why the world keeps saying something different? And what can we, or people in the room, do collectively here to try and combat what sometimes are called urban myths, but myths way beyond urban myths? So any of you want to take a shot at that? Neil, you're nodding here, so maybe I'll start with you.
Oh, well, I think when you mentioned this 6% number. So, you know, one of the I think most informative things that that I think we did a long time ago was when this whole debate about, you know, did CRA have, you know, an important role in generating this subprime boom and bust. You know, we just did a simple thing of looking at the data and
right.
saying, hey, look, all right, in HMDA data, we can see in 2005 and 6, you know, there's a huge number of these higher cost loans, sort of a proxy for subprime. We know that, you know, amongst those loans, upwards of half of them ultimately defaulted. Where did they come from? And basically, only 6%, if you think CRA did something, only 6% can actually be linked to banks making loans to LMI borrowers or neighborhoods in their assessment areas. 6% is not a lot of the, so what happened, where did the other 94% come from? In fact, over half were made neither to LMI borrowers or neighborhoods. So there's absolutely no conceivable way they could be linked to CRA. So those were two key facts, and I think they pushed the conversation away from CRA for a little while. But, you know, I think ultimately there's a strong intuition behind the argument that, you know, hey, CRA, the intention is to get more loans to low-income borrowers, and we had this big boom and bust. It must have, maybe that's the explanation. And it's an intuitive story, and I think people hang on to that, but they don't, but there's not, at least most of the time when I see these arguments made, they're just based on the intuition, not on the facts. Ultimately, the facts are kind of what I just said, and If you really think about the institutional details behind CRA, I've always thought of it as a nudge, not a budge or a hard push to make loans, and that kind of story generally bears out in all the analysis, the hard analysis I've ever seen of CRA. So I think sometimes the sort of stories that people like to tell aren't informed by the facts, and it's hard to. I think it can be hard to dissuade people from something that's so intuitive.
Paul, I know you've been taking this pitch on the road from the very beginning here as to really what was the cause and who's being harmed and whatever. And the fight hasn't ended, but what are your reflections on the fact of how hard you've worked at this and why it seems so hard to maybe, I don't know, change people's minds or to get through to the general press?
I think what Neil said, I think one of the things that is hard is that you can, these facts, as I said, many of these facts are, once you see them, it's very hard to argue with them. And one of the examples of this is there was always this idea that the financial intermediaries caused the crisis because they had no skin in the game, and there we were in the fall of 2008 dealing with financial institutions with hundreds of billions of dollars worth of losses, and somehow having someone lecture me about how the problem was that they had no skin in the game. And so you could explain that to people, and I think when you explain that to people, they would say, oh yeah, that makes sense, you're right, that's right. And then what was frustrating was then you'd talk to them a month later and they'd have just gone right back to saying it was about skin in the game. And I don't, you'd put these, Mark had asked us about all these sophisticated econometric techniques, and there is a place for sophisticated econometric techniques, but a lot of what we know comes from really just really careful data collection, and just doing simple things. And as a matter of fact, this fact about the distribution of debt, it never even occurred. It's such a simple thing to do, and we can do it with the Survey of Consumer Finances, which the board has been putting together very carefully since 1989. It was very easy to do. We just never thought we were doing all these complicated differences and all this stuff. And then you think, why don't we just take means? And which my kids could do in 7th grade, and they didn't need PhDs. But so that's the hard part is, and then you can explain to people, and they're very convinced, and then there's a sort of decay.
I want to make just a quick pitch here for data. So I think you can see the value of it. And sources of data are greatly at risk now. Many of you may be aware there's a big fight over the census. And if we lose some of this data that is collected or it becomes less available, that could seriously impede bringing facts and doing simple means and averages and whatever. So all of you, if you have a chance and somebody says something about budget and not thinking about the census, which the 2020 census is in true jeopardy, I'm told, so this really needs attention. Anyway, Tim, you came with something here a lot more complex. I asked you to talk about that, but how do you think about getting the message across here?
Yeah, I mean, I think that we have similar problems, similar to what was just said. I think in the affordable housing space, you kind of have these really two binary narratives, and I think people can get somewhat entrenched. And I think so. The one narrative is sort of what you would call the NIMBYist narrative, which is that if you build these affordable housing complexes in my neighborhood, the neighborhood's going to suffer. So I don't want this built here. It's clear that in certain neighborhoods that's not the case. And then the other narrative is that, well, if you do just build these complexes in low-income neighborhoods, then what you're doing is you're entrenching segregation. And at least what we're showing is that it can seem to actually be beneficial in the sense of bringing in some non-minority home buyers, and at the same time, there's a scope. I think there's a real scope for government intervention in these neighborhoods because these positive spillover effects seem to be quite large in these neighborhoods, and it's very difficult for private developers to capture all of these positive spillover. So this is kind of the classic. This is the classic place where you'd actually want government to kind of come in and incentivize investment in these areas. And I think that documenting these positive spillover effects will hopefully kind of get us out of this binary narrative to kind of help us understand that there's real trade-offs involved in terms of where we build affordable housing developments, in terms of indeed helping low-income residents move to higher-income neighborhoods, which does have real benefits, but at the same time stimulating investment in low-income neighborhoods, which can really benefit from that investment. So I hope what would happen is that as we bring more evidence and more data to bear, we'll start to have a more balanced discussion of what are the trade-offs, and that in certain neighborhoods one thing might be appropriate, and in other cities another type of development might be more appropriate from a policy perspective.
Right. I want to just pull out very briefly here something that you said, this externalities. I think. So the term market failure is thrown around all the time, and it's not, market failure isn't the market's failing to do what I'd like it to do. The example that you give, and I just want to highlight that, is where a developer can't capture all of the benefits that are happening as a result of this development, but you want them to go ahead based on the overall benefit to society.
Based on the social benefit.
There is logic there for government to intervene.
Right, through programs such as the low-income housing tax credit.
Right.
Yeah.
So Buzz has given me the signal here. Unless there's a super pressing question that you want to ask all three of them, these gentlemen will be here for certainly through the break here, and if you want to ask them some follow-ups to what they've done. I think these are examples of some just terrific research that's being done out there that I believe it certainly helped me when I was in carrying out the activities that all of you are doing, and I think can be very helpful to you, as I said, both internally in making the case and dealing with the myths that are out there, but also I think more generally in talking about the importance of the work that you all do in strengthening and rebuilding communities. So join me in thanking the panel.